The government moves to bury the ghost of the retrospective tax, sets up a 10-member panel headed by Justice Easwar to review the income tax laws. Justice Easwar confirms exclusively to CNBC TV 18 the committee will look at Section 9 of the Income Tax Act, which was retrospectively amended.
I don't think it makes sense divesting at a time when the prices are low.
You heard it first on CNBC TV 18, and here's the official confirmation. Divestment target may not be met as Finance Minister rules out selling stake in metal companies. However, Arun Jaitley also shows the fiscal deficit target is not under threat.
Indigo's 3,200 crore rupee IPO takes off with strong demand from institutional investors, but demand muted so far among retail and high net worth individuals. The total IPO size has subscribed nearly 86% on day one.
Telcos urge the government to drop the proposal to penalize them for call drops. Says the penalty could result in closure of networks and higher tariffs, as the industry may have to shell out up to 54,000 crore rupees annually.
Maruti is on target in Q2 as margins beat expectations once again. No such luck for Lupin as profits plunge 35% and margins shrink rapidly. Axis Bank posts a stable second quarter in line with expectations.
In a bid to expand the market for mutual funds, SEBI Chairman UK Sinha calls on e-retailers to sell products in their online platform.
We are trying to monetize all the assets of railways. Some part of monetization plan is something which we are doing in terms of station development, where the land and air rights could be developed without selling the land, which can bring in huge amount of money.
Suresh Prabhu moves faster to improve the health of the Indian Railways, says the ministry is on track to monetize its assets. That's a CNBC TV 18 exclusive.
As the battle for Bihar intensifies, we take you inside Prime Minister Narendra Modi's Hajipur rally to find out who owns the aces ahead of the crucial third phase of voting scheduled for tomorrow.
The way to characterize the policies of the government is Congress scale plus a cow. There has never been as great a centralization of functions, not power, of functions in the PMO as now. But I feel that there has never been as weaker a PMO as now.
भारतीय जनता पार्टी के नेताओं को और नरेंद्र मोदी जी को उनसे अच्छा कोई नहीं जानता, इसलिए अगर वो बात कहेंगे तो उस बात के अंदर वजन होगा।
एक कैबिनेट मिनिस्टर रहे हैं, उनको इस तरह का वक्तव्य नहीं देना चाहिए क्योंकि सच्चाई नहीं है इसमें।
I think the mood is clearly shifting on this government, right? In the sense that I think people are starting to, the patience is starting to wear thin.
It's the most scathing attack so far on the Modi government, for former BJP Minister Arun Jaitley not only called the Modi Sarkar Congress plus a cow, he also said the Prime Minister's office is the weakest he's seen so far. Forced into damage control, the BJP is saying Jaitley is not a party member anymore. Good evening. Thanks very much for joining us on India Bizarre. I'm Nandara.
Hi Shri, while we're talking about Arun Jaitley, he didn't just stop there. He went on to say people have started to recall the days of the former Prime Minister Manmohan Singh and called on the Home Minister Rajnath Singh to resign, and he's become an object of pity.
Well, we'll talk politics and the Bihar battle in just a bit, but first to the day's trading action. Consolidation was again the order of the day on Dalal Street. Profit booking continued throughout the session, but the loss is minor. The Nifty lost nearly 30 points, moving closer to the 8,200 mark. The Sensex lost over 100 points once again, but bulls can take solace from the fact that the markets did not end at the day's lows. Mid-caps faring slightly better than the blue chips, as the mid-cap index ended marginally in the green. That's the market for you. But the top story tonight, the big CNBC TV 18 news break. The government has set up a 10-member panel to ensure that income tax laws are simple and predictable with certainty. Former Chief Justice of Delhi High Court, R.V. Easwar, will head the panel, which will look at Section 9 of the Income Tax Act, which was amended retrospectively. Justice Easwar has confirmed exclusively to CNBC TV 18. Before we get to him, let's go across to Netar. Netar, you've been tracking this story, and of course, Justice Easwar now confirming to us. But what else are you hearing from your sources in in government.
It was a story we broke in the morning right here, Shireen, how the government for the first time ever was actually considering repealing that controversial retro tax. Like we've had some global voices on the channel. For example, Boeing as recently as 7 days to 10 days back saying that, verbal assurances from the government that they will not open new cases on the basis of that retro tax is not good enough to convince the global boards to actually put money in India. So we got murmurs that the government was looking to repeal that. Any repealing or modification will of course have to go to Parliament, maybe in the budget session if the government is ready to do that. So then what I picked up from my sources was that Jayant Sinha had been asked to lead the discussions on this front. Do remember the Finance Minister Arun Jaitley has recused himself, saying he had represented Vodafone in the past. How can you talk about resolving the retro tax issue and not talk about Vodafone? And perhaps that's why Jayant Sinha was given the responsibility. We had also reported on the channel that perhaps Jayant Sinha and the Finance Ministry was going to rely on a judicial commission, an expert panel to lead them to do so, and that is exactly what happened by the evening. By the evening, we saw the press release where the government has constituted a 10-member panel led by the former Delhi High Court Judge Justice Easwar, and it also has members from the private sector. For example, you've got Ajay Bell of AZB, you've got Raji Mimani of EY, you've got other chartered accountants, a former law secretary as well, to simplify the income tax law, is to talk about not just simplification but to reduce litigation to the bare minimum and to bring predictability. So Shireen, if you want predictability, how can you have sudden retrospectivity? So I reached out to certain members. We'll of course get the soundbite of Justice Easwar in just a bit, but some of the other members that I spoke to in that committee, they said not all retrospective laws are bad. We will discuss, for example, that should the government introduce a retrospective law once it's lost a case in the Supreme Court. But you also have other instances where the government realizes in hindsight that perhaps we've given an undue and unintended benefit to a company, and in those cases a retrospective order is not bad. We also understand it's something confirmed by Justice Easwar. They're going to look at exemptions. We have a long list under Section 10 and Section 80, which has distorted the effective tax rate. Also, Vodafone, it's about the retrospective capital gains tax and indirect transfer. But guess what? When you talk about prospectively, we still don't have rules to govern that. Yeah. So that also is going to be taken up.
All right, Nantara. And we spoke with the man at the moment, Justice Arun Jaitley, just a short while ago, and started by asking him about the terms of reference given to the panel by the government. Listen in to the Big CNBC TV 18 exclusive.
Thrust of the terms of reference appears to me to be that the litigation should be reduced to the bare minimum than what is precisely necessary, and that itself is a simplification. And that is why they have said in clause number 2 of the terms of reference clause number 1, identify the provisions and phrases of the Act which lead to litigation. So if there is simplification and clarity on certain terms, for example, there are several incentive provisions, Chapter 6A. There are several terms which have not been clearly defined. That is one area which the committee will probably be looking at. Then the other area will be the Section 9, where there are certain terms which have been judicially interpreted in a certain way, and whether anything can be done to achieve uniformity in the way in which those terms have been interpreted by different tribunals and courts. That would be one area, so that the litigation becomes minimum, which automatically will answer the term number 2, which is ease of business, ease of doing business. If there is less litigation, there is better way of, there is ease of doing business. This is one aspect which we would like to examine. The other aspect is that there are two kinds of provisions in the Income Tax Act broadly. One is the substantive provisions and the other is the procedural provisions. The scope for simplification in the substantive provisions will have to be conditioned by term number 4, which says it should, without substantially impacting on the tax base. So there probably the scope is not as much as the simplification process of the procedural provisions. The procedural provisions will also impact term number 2, ease of doing business, and there are certain cumbersome rules, procedures, forms to be filled up, which probably need to be simplified. And this is one area which the committee would like to look at. This is my prima facie thing, prima facie view. And we have experts from all sides, the chartered accountancy profession, the former law secretary is there, then the investment side is also represented, and we have some very competent and able officers from the Revenue Service. So I think all these issues will be addressed.
You've been able to articulate for us now more clearly, sir, on what we can expect in terms of the areas that the committee is going to be looking at. But if I could get you to expand for us, sir, what you said as far as Section 9 is concerned, and if I could get you to link that to the terms of reference and clause number 4 in the terms of reference, which says to suggest alternatives and modifications to existing provisions and areas so identified to bring about predictability and certainty in tax laws, sir. This has been the big bugbear as far as investors are concerned. The retrospective tax law that was brought in by the former UPA government. This is going to be something that you will be addressing, a possible modification as far as the retrospective amendment to Section 9, sir?
That is right. But I have to enter a caveat here. You see, this Income Tax Act has been there since 1961 for almost now 55 years. Now, there are several views have been taken in respect of almost all the provisions, either by the courts or the tribunals and all that, and also by the authority for advance ruling. Now, there has to be a reconciliation wherever there is a conflicting interpretation. Number two, it has always been my view that simplification is probably the most difficult. It's not so simple to simplify. If the business models have become complex over the years, it is no longer a very simple business model with cross-border investments and all that. If the business models have become complex, perhaps, I'm inclined to think that the tax laws also need to be a little, complex to meet those complex situations. But the secret lies in trying to be as less complex as possible. So I would rather think of dealing with those situations the way in which the government wants, but in not so much of a complex language, but a simple language, so that everyone is clear, and therefore the litigation is brought to minimum. And so time and expense in litigation is not lost.
You said that the terms of reference do not include the aspect of looking at whether something should be applied retrospectively or not. But if you can clarify once again for us, as far as Section 9 is concerned, as part of the terms of reference, what exactly is it that the committee will be looking at, sir? And whether there will be any comments offered on what happens if there is in fact a Supreme Court order and a law is amended retrospectively. Is that going to be something that you would be considering at all as part of the terms of reference?
As I told you earlier, the terms of reference do not refer to any prospective retrospectivity and all that. So in the course of the discussions, if something comes up, certainly the committee will be open to consider them. And then if there is some substance and if the stakeholders raise valid points, perhaps there is scope for including them in the report, in the committee's recommendations. But basically, as I told you, it is entirely for the government to legislate prospectively or retrospectively, even in tax legislation.
Justice R.V. Easwar there speaking to us on the terms of reference for the committee that he will be heading. Joining us now to discuss the implications of the terms of reference of this committee is Dinesh Kanabar, the CEO of Dhruva Advisors. Mr. Kanabar, appreciate you joining us here on CNBC TV 18. Sir, you just got a glimpse of what Justice R.V. Easwar had to say to CNBC TV 18 on a story that we've been tracking. What do you make of it, and how significant do you believe this is likely to be?
So if you look at the pronouncements that have come either from the Prime Minister or from the Finance Minister over the last 4 to 6 months on a consistent basis, one message which has gone out is to say we do recognize that tax is one of those issues which is impacting the ease of doing business, and we would like to simplify matters. And I would believe that this committee is a very, very significant step in the right direction. And more important, Justice Easwar is a person who has sat on the Income Tax Appellate Tribunal, then as a judge of the High Court, and probably somebody who's so well versed with the tax laws that I'm very sure that this will go a long way in sort of trying to resolve some of the maze on which we have found ourselves. So it's a very, very welcome step. As to
speaking of
when I heard the terms of reference,
yes, sir, go ahead.
As I heard the terms of reference, I think at one level they are very narrow, at another level they are very, very broad. They are narrow in a sense that you are looking at just simply, actually according to me, the law is not complicated. It is really the administration of the law, the way we have gone about implementing some of the provisions which has created a number of issues. So if, for example, the committee can come back and make a recommendation to the government on certain position papers being published by the government on what is its view on interpretation of a particular section, then people doing business really got to know really where the government stands. Let me give you a couple of examples. The government just very recently came out with what I think is a very significant step about permitting a range concept in transfer pricing rather than just an arithmetical mean. A very significant step. But the rules came a year and a half late. Similarly, the government has come out with a very important provision that as a taxpayer, you can go to authority for advance ruling whether you are a resident or a non-resident. Now, that said, today there is a backlog of 4 years to get a ruling from authority for advance ruling. You can't get a ruling 4 years later in advance. You need to constitute benches. So I think there is a grave mismatch between the law and the implementation of the law, and I do hope that the committee addresses many of these issues.
Right. Very quickly, Mr. Kanabar, if I can get your pointed comments on what Justice Shah has had to say as far as Section 9 is concerned. And I'm quoting to you what he says. We will be looking at the judicial interpretation with regards to Section 9. That will be discussed by the committee. And he also says that retrospectivity or prospectivity is, of course, the government's prerogative. But during the course of the conversation, were those issues to come up, the committee will have an open mind. How would you read specifically on what Justice Easwar has to say as far as Section 9 is concerned, sir?
So here is one aspect which has sort of muddied the government's name more than anything else. It was just one isolated case where after a matter reached the Supreme Court, there was a retrospective amendment. Till today, government has not collected a penny of taxes on this issue. That said, today, the amount of negative media, publicity, everything else that it has given is very, very significant. So, on the one hand, you have a feeling that it takes a long time to get a conclusion. It takes 12 to 15 years before you get a judgment from Supreme Court. People are normally very sanguine to say you get the right answers from the Supreme Court. But if the government was to retrospectively legislate, that really undermines the entire judicial system. That was in question when the retrospective amendment came. If this panel was to look at that entire thing and come back and say that this retrospective amendment could not have been clarificatory in nature, it ought to apply only prospectively, that would be a very, very significant step.
All right, Mr. Kanabar, we'll have to leave it there. Appreciate you joining us on the big scene, BCTV 18 story tonight. On to another exclusive. The almost 70,000 crore rupee disinvestment target will be missed, but the fiscal deficit is not under threat. The clarification was made by the Finance Minister in an exclusive conversation with me earlier this morning. Jaitley admitted the government has deferred stake sales in metal and oil companies for this financial year as both sectors are down in the dumps. He also tried to allay concerns of a cut in expenditure to meet the revenue shortfall. The government's revenue coffers are facing some serious bumps, but the Finance Minister says there's no cause for panic and no threat to the fiscal deficit target of 3.9%. The government is unlikely to go ahead with stake sales in metal companies this year for both strategic sales as well as partial stake sales, which could bring down actual disinvestment receipts to under 30,000 crores versus the target of almost 70,000 crore rupees. In addition, direct tax collections are expected to miss the target by an estimated 50,000 crore rupees. But the Finance Minister says this shortfall will be made up by rising indirect taxes.
I had therefore consciously this year kept a very modest fiscal deficit target. That is a movement from 4.1, it eventually became 4% to 3.9%. And I think the manner in which tax revenues and expenditure are moving, I don't see there is going to be any difficulty. You are right, as far as disinvestment is concerned, there are a few challenges, and the challenges are particularly because on account of the global prices, the metal stocks are not doing particularly well, and metal was a large part of the kitty that we had planned for this year. And therefore, I don't think it makes sense divesting at a time when the prices are low. The real test is of how the economy is doing is how much revenue from indirect taxation are you going to collect.
Also, senior finance ministry officials indicate there could be a fiscal cushion to the tune of 30,000 to 40,000 crore rupees this year, as many ministries may be unable to fully spend their budget allocations. While there is talk of the government being forced to clamp down on expenditure, we hear it may reinstate a ceiling of 30% on spends by individual ministries. This will do away with the need for an actual cut in expenditure to meet any revenue shortfall.
I don't think this year we'll have to cut down expenditure of either state governments or public expenditure or the central ministries. As it is, we are moving ahead of our targets as far as indirect taxations are concerned.
Tax officials also indicate the estimated 50,000 crore rupees shortfall in direct taxes is overstated as of now. The actual gap could be lower by 50%, narrowing down the shortfall to roughly 25,000 crore rupees. However, it's also early days to do the fiscal math, with the third quarter yet to end. Probably the next official indication on the government's fiscal story would be available at the time of the release of the midterm review, which will be tabled in Parliament during the winter session. In New Delhi with Sapna Das, this is Shireen Bhan.
So the shortfall in divestment will not put the fisc under threat. But guess what? IDBI Bank could come to the government's rescue to shore up its divestment receipts. The Finance Minister had told CNBC TV 18 in September that the centre was looking at paring down its holding in the bank, similarly to what was done with Axis Bank in the past. Sajid Mangat reports the centre could look at offloading 25% in the bank without amending the Articles of Association, and at current valuations could fetch 3,500 crore rupees.
As the government stares at a gaping hole in its divestment receipts, it is looking at all options to shore up revenues, and offloading stake in IDBI Bank could be just what the doctor ordered.
We still have, quite a number of interesting opportunities even on the divestment side. The Honourable Finance Minister has already said that we will consider transforming IDBI in a manner similar to the way Axis Bank was done. And so we have opportunities there as well. So let's see how it all plays out.
The government owns around 76.5% stake in IDBI Bank. It is unlikely that the government will privatize the bank this fiscal, since that would mean it will first have to change the Articles of Association of the bank, which stipulates holding minimum 51% by the government at all times. But that doesn't mean the government can't divest up to 25.5% this fiscal to other domestic financial institutions and insurance companies. If the government opts to sell this stake this fiscal, it could fetch the government around 3,500 crore rupees at current prices. With just 5 months left in the fiscal, it's a race against time, but Finance Ministry officials say the work has begun. In Mumbai with Sajid Mangat, Surabhi Upadhyay.
So we could see the government moving on, paring down the stake in IDBI Bank this fiscal itself. Now, Indigo's 3,200 crore rupee IPO has taken off on the Lal Street. The biggest debut in 3 years is seeing strong action in the institutional category, with the QIB portion being subscribed nearly 3 times. Farah joins us now with the latest details. Farah, day one for Indigo, what does it look like?
Well, one can certainly say that Indigo got off to a promising start on day one, with the issue being subscribed 87% or 0.87 times on day one itself. Of course, the highlight of the Indigo IPO action on day one was the QIB portion, or the qualified institutional buyer category, which was subscribed 3 times, largely backed by foreign institutional investors. However, the high net worth individual category, or the non-institutional investor category as they call it, as well as the retail investor category, showed quite muted sentiments, with the high net worth individual category being subscribed 2% and the retail investor category being subscribed 5%. But do remember that this is usually the case on the first day of an IPO, and the retail investor action usually kicks in on the second and the third day. So therefore, we will be keenly watching out to see what kind of retail investor interest this Indigo IPO generates. Of course, do remember that Indigo's IPO is the largest in the last 3 years, and this time the company has got very strong fundamentals to back it. It has been one of India's leading carrier with a domestic market share of 35.3%, and it has been the only carrier to be consistently profitable for the last 7 years. So all eyes out on what happens on day 2 and day 3. Back to you.
All right, Farah, we will be tracking the action on day 2. Thanks very much. That's Indigo's IPO for you. Now, the call drop compensation policy or order, which was announced last week by the TRAI, is giving telecom companies sleepless nights. In fact, the COAI and OSPI, both bodies representing telecom operators, have shot off a letter to the regulator urging it to withdraw the compensation order, claiming that providing compensation could cost telcos up to 54,000 crore rupees annually, resulting in telcos having to pass on the additional cost to consumers or shutting operations in certain circles. This letter comes 2 days ahead of the TRAI chairman's meeting with telecom company bosses. Prerna Barua caught up with the Director General of the COAI and asked him about the arguments that the industry body would put forward to the regulator. Listen in.
Above and beyond the financial impact to the operators, which is rather severe, is the fundamental issue that what is in our license conditions vis-a-vis the DOT and what is here in the regulation is directly in conflict. So we, as operators, are caught between a rock and a hard place, saying is that, look, there needs to be consonance between the two, and we have pointed out that there is a lot of dissonance between what is required in our license and what is there and versus what the regulator. For example, 100% coverage. Nowhere is it required. We're only required to provide 90% coverage. So these types of anomalies have perpetuated this thinking that, by giving money back to the consumer, you're going to solve the problem. This is the equivalent of doing brain surgery with an axe.
That's a distress call made by the telcos to the government. In earnings corner, Maruti Suzuki met street expectations today with the second quarter earnings. The country's largest car maker reported a 42% jump in net, which it attributes to higher sale volumes, material cost reduction and favourable foreign exchange. CNBC TV 18's Shweta Kothari reports the company has also decided to seek shareholder approval for its controversial Gujarat proposal, and that will be on the 16th of November.
Helped largely by a near 10% jump in sales volumes, Maruti Suzuki today reported yet another strong set of earnings. The company's profits shot up by 42% year-on-year to Rs 1,256.6 crores, meeting CNBC TV 18's projected 43.7% increase. Maruti's net sales during the quarter stood at 13,574 crores, jumping 13.2% over the same period last year, as against CNBC TV 18's projected increase of 13.6%. During this period, the company sold a total of 3.53 lakh vehicles, marking a growth of 9.8%. The management is buoyant on the road ahead.
Domestic growth has been more than about 12%, but exports from the first half were a little bit low, largely because a shipment got delayed. In the half year, if you look at the half year results, exports are actually higher than last year. The margins have remained almost unchanged from quarter to quarter.
The company's board also took the decision today to seek minority shareholders' nod for the Gujarat plant, which the company says will be operational no later than May 2017. Maruti will seek shareholders' approval through a voting process that will be open for a month, starting November 16.
I believe that it may be possible to commission the Gujarat plant actually a couple of months earlier than that. We believe we need the Gujarat plant as early as possible because certainly in 2016 the capacities available in Gurgaon and Manesar will be fully utilized.
Importantly, the board today also finalized a new royalty plan under which payments to parent Suzuki will be in rupees and not yen, as has been the practice. This is expected to insulate the company's bottom lines from the currency volatility. In New Delhi, Shweta Kothari.
Well, that's Maruti for you. But staying with Motan, two-wheeler maker TVS Motors posting a solid set of Q2 earnings. Profits up nearly 23% thanks to a 7% growth in sales. The biggest surprise on the margin front, the company was stuck in the 6% range for a while, has finally managed to break out and post margins of 7.4%.
Lupin posted a disappointing set of second quarter numbers. Profits plunged 35% as the company blamed slowdown in US approvals. Margins also contracted by 600 basis points.
Axis Bank posted a stable set of Q2 earnings. Profits up nearly 19% as income jumped 15%. Asset quality remains stable.
Vedanta's second quarter turned out to be a mixed bag. Zinc and aluminium business dragged, while copper and power segments delivered a steady performance. Vedanta's CEO also said the company is not considering the plan to sweeten the offer to minority shareholders currently. That's for the Clean India merger, and the operative word being currently.